Welcome, everyone, to the Wolf Financial Podcast. That is the Solid Report. Yes, sir. Yes, ladies, it is the Solid Report. Welcome back. Welcome back. We are here on Tuesday, January 13. And I don't know. I thought the market was going to go green. It didn't go green. It went red, and then went green, and went red again, and then went green again. But One Stop Shop OSS ticker has been green all day long. Welcome everyone to the Wolf Financial Show. Let me just take a look at something else over here real quick. All right, so we have an interesting show for you guys. It's been it's about 24 hours since the last time I streamed, which is pretty good timing, right? About once a day is doing pretty good. And we are here to talk about a few things on the board. So we have the headlines flashing across the board with a bunch of different things happening. I can't even keep track of all of it. We're going to dig a little bit into what's happening with Trump right now. Actually, he's talking live right now, and he did make a few comments on some things. One, the credit card 10% cap, the Jerome Powell open inquiry, whatever you want to call it. And of course, people are asking questions about Venezuela and Iran and everything. But we're going to play a little clip from that one. Then after that, we're going to take a look at a 30-second clip where he did say some specific words about Jerome Powell. I'm going to be neutral on this one. I just want the stock market to go up, as you guys do know. We're also going to dig a little bit more into this 10% APR cap rate and what this actually means for a lot of companies. And then we're also going to talk about Intel. It's almost at $50, which is pretty wild to see. AMD and SE Limited are moving pretty crazy today, opposite directions. So it is what it is. No, I am not in OSS. I wish I was in OSS, but sadly, I am not in OSS. But that thing just does not stop going up. Adobe, I'm not too happy about that move either, and I'm not too happy about Meta. But it is what it is. There's nothing you can do, and there's nothing we can do. We just sit down and wait. But what's going on, everyone? Ticker Tap X, what's going on? IA fan, what's going on? Cameron, Sense, Derpy Rock, Awan, what's going on? And I see when I read this, I see the word baggery. And I don't know, that doesn't really mix too well with me, but it's all good. Yeah, I know it makes me a little sad too as well. But welcome everyone. Welcome back to the podcast. Let's jump right into it. All right. So first thing on the top, I wanted to go over this thing right here. Ahmed posted this morning, actually not even this morning, just like a few minutes ago. So I wanted to touch on it right now. This is going to be my first time watching this as well. So let's go ahead and see what Trump has to say.
Great numbers. They raise interest rates to try and kill it. So you can never really have the kind of rally you should have. What happens and what we want, we're going to have a lot of great months, a lot of great quarters. I want the market to go up. You announce unbelievable numbers and the market goes down because they know you're going to do everything possible. In the Fed, we have a real stiff in the Fed, but that's for another day. But they raise rates. So everyone says, oh, they announced great numbers. It's great, great, great. And the market goes down because they immediately raise rates. No, when the market goes up, they should lower rates. You want to see 20% and 25%? You want to see what we can do? We've got to go back to an old standard. When there's good news, the market should go up, not go down. Does that make sense to everybody? And that's the way it used to be for most of the time. That's the way you make a country great. But our growth potential is unlimited and could be much higher if we went back to sanity. We're not doing it anymore. We're talking about the head of the Fed, and I want somebody that when the market is doing great, interest rates can go down because our country becomes stronger. See, you view it differently. Our country becomes stronger, and therefore interest rates should go down, not up. They kill every rally. If it's, no matter who, if it's beyond me as president, it's no matter who's president. You have a good quarter, and they want to kill it because they're so petrified of inflation. And growth and inflation don't necessarily go hand in hand. You can have growth and very low inflation. In fact, oftentimes growth is good for low inflation. So we're going to work on that, Scott, right? I think we're going to work on that very hard. I mean it so strongly, it's sickening. We announce good numbers and we see the stock market drops 300 points. I say, what the hell is going on?
So, am I the only one that doesn't look at the Dow? I mean, he said that they released good numbers and the stock market drops 300 points. I think he's referring to, I don't know. I think he's referring to the Dow because if that was over a period of time, it did drop about 300 points recently, but I think he's referring to the Dow. I don't know. A lot of people look at the Dow. think there's like an age limit where it's like, I'm no longer going to look at the Dow. I'm going to look at S&P 500. That's what I'm looking at. And today, the S&P 500, let me bring up the charts over here real quick. Oh, we're actually having a little bit of a good day here when it comes to these windows. Nope, we're not having a good day here. Actually, I'm messing up again. I'm messing up. All right, here we go. So we have the market is just like up and down. Like it was literally just green a second ago. Most of the time I'm actually looking at the Qs because my portfolio is a bit tech heavy, but the market is down about 37 basis points. I mean, we just had a new all-time high yesterday, so you can't really complain if we're down not even 0.5%. Amazon, of course, is down as it usually is. Meta is down as it usually is, or lately, that's really been the case for a while. It's down at 628. Adobe is down 6% today. 6%. Is that wild to think about? Why is Adobe down 6%? Well, I'll tell you the reason why Adobe is down 6%. It is because of this right here. Let me share this screen for you. Oh, that's not the one. Here we go. All right. So one of our good friends, Arya, he actually has an excellent YouTube channel. Shout out to Arya. But basically, he's showing over here, this is actually his price breakdown for valuation of Adobe, which is pretty considerably cheap. Now, we want to go back to the reason why it's down. Wow, that actually was not the one. I think I saw that it was like a major downgrade or a downgrade from someone who was actually bullish on Adobe recently. All right, here we go. So analysts who cover Adobe stock have turned the most bearish on the company since 2013. So we had today that a company or a sell-side firm did go bearish in Adobe and they downgraded the stock, specifically Oppenheimer downgraded Adobe, and it's down about 6%. If we look at this chart over here, this is the recommendation consensus for Adobe, and it is quite possibly the worst we've seen in over a decade. Now, going back to the previous tweet that I had from our boy Arya, I got to tell this guy to change his picture. He needs to look happier in that one. Anyways, where was his Adobe valuation one? Yeah, here it is. All right, so he has over here that Adobe has 5% buybacks, 10% revenue growth. So, did I just say that? 10% revenue growth, free cash flow margins, all right? Even though it has really good free cash flow margins, they're still remaining flat, which means that they're not losing profitability. And 0 multiple expansion. So what he's trying to say is that Adobe's very cheap at today's price. According to his indicators, he thinks the revenue by the end of the year is going to be $30 billion. He thinks the free cash flow per share is going to be about $36. Free cash flow beginning of the year is $9.6 billion, I believe. Let's see here. Free cash flow margins, 42%. Current price to free cash flow is 13-14. He's saying the free cash flow CAGR, compound annual growth, is about 11%, and he's projecting this at 228. So he thinks the company is going to return a CAGR of the average. The base case is 15% here. But he does believe that the company could be worth about $900 in his bull case. Base case is $555, which is that's a 21% CAGR, and that's almost a double from here. So is Adobe going to go into the 200 range? That would be wild to even think about. All right, so here's my issue, and we're going to move on to the rest of it after I give a little bit of a talk in this one. This is some real talk. I do not want to be a bag holder. All right, I don't want to hold stocks that are not the bottom when it comes to certain value perspectives, right? So valuation wise, is Adobe bottoming today? It's very difficult to say if this is going to be bottoming. I mean, like I thought we had the bottom, but now it just made a new 52-week low. Okay. The last time it was trading around here was back in 2022 when we had the ultimate bear market. I thought this was the bottom. This is when I bought right here. And it was great. And boom, kablamo. All right. 4% position. I think now it's like close to 3% position all in shares. I don't want to be a bag holder. I'm sorry. It's very difficult for me to continue holding this company if I see the chart trending downwards. I only like to buy in upper trends or reversals into upper trends. And this is a potential candidate for me to cut this position. And if I do, then I'm probably going to make that decision today before the market closes, or I'll just make the decision tomorrow, whatever it is. But you guys already know, very bullish Zeta. I'm bullish path. This isn't a humongous position, but I am bullish path as well. They're going to be re-excelling revenue for the next 2 years. So that does have that positive mode. Also, they're inflecting on the fourth quarter of profitability, supposedly coming up, which is great to see. Bullish on semiconductor. You guys already know about that. Bullish Amcor, and I have a bunch of other positions here, Hood and Lemonade. Great stuff. I don't hold BMNR. This is just the watch list, but we'll talk a little bit more about crypto later on. But do I want to be an Adobe bag holder? Hey, this could turn out to be a great thing, right? This could be $555 in 2028. And I'll be very happy about having a 20% CAGR until then. But the question is it going to be dead money for some time? Or am I going to start losing money for some time? Mind you, not selling means that you didn't lose, right? So if you don't sell, you don't lose. Also, if you don't sell a gain, then you don't gain either. But that's the question here. 3% position. Is this really going to matter if it becomes a 6% position in terms of its actual size, considering today's portfolio size with the 20% CAGR? I don't know. It doesn't really seem worth it to me, in my opinion. I'll make that decision. I'll keep you guys posted on that one. I'll post that update on Twitter, whether I'm actually still in it or not. But, mind you, this was a 3%, 4% position to begin with, and it's all in shares. I don't have any options on it or anything. And it's very difficult to call the bottom of this thing, especially when Wall Street is just completely bearish on it when the market is at all-time highs. Just very difficult for me to do. And plus, I haven't really been in this for a long time. I just got in this a few weeks ago. So, it is what it is. I'd rather cut my losses than to continue looking at a falling knife chart. I'd rather look at something like this. Or I'd rather look at something like this, or even like this. This isn't the best thing to look at, but I really do like their fundamental sides accelerating. A lot of the companies I invest in are either expanding margins or increasing revenue, or both, right? And usually that means that they're associated with a secular trend, right? Is there a secular trend with Adobe? I don't know. This is more of a value play for me, but is there a secular trend with this? In fact, it's the opposite secular trend, but set aside sentiment. The price is kind of telling you this is not the day to be buying the massive dip in Adobe right now to guess at today's bottom. That's the difficult part when it comes to this stuff. And that's a difficult time it comes to when you invest in companies from a valuation perspective, strictly a valuation perspective, where there is no secular trend moat in this company. And unfortunately, Adobe doesn't have that, right? There is one candidate that I do know that had this exact same sentiment. PayPal. That is definitely not PayPal. That's Pipe. Right. So this is another company that is doing what it does best, as always, not losing profitability, not slowing down revenue dramatically, but they are slowly losing market share and so on. This is a very competitive industry. And if you thought this was the bottom, you were wrong. If you thought this was the bottom, you're wrong. If you thought this was the bottom back a year ago, well, you're right for a little bit, but then you're wrong again. This is the type of stuff that I don't want to get involved in, right? I don't want to get involved in things that are not like growing market share, that are slowing down in revenue, or maybe it's not slowing down revenue, but are at least losing market share. It's very difficult to stay in these type of companies. I'm not sure if I want to do it. I'm not a shareholder at PayPal, but it's like, well, if I'm trying to outperform the market and I want to concentrate positions to portfolio, I got to make decisions to cut certain things. And I don't know, this is probably going to be one of them. So I'll keep you guys posted on that one. So let's go ahead and move on with the rest of the show. All right. So how did this dude get into Adobe? How did he get in? I don't even know how. Oh yeah, I was looking at the market. All right. So I was looking at the stock market and then I got distracted with Adobe. All right. So we're sitting here. Oh, wow. That is not cool. All right. This window, boom. All right. So we're sitting here near the session lows, but I mean, like, come on, guys, zoom out. This is nothing. This is nothing. Like this is nothing. You know, it'd be really cool to see the Qs make a new all-time high. And we have that tariff catalyst tomorrow. We have more than a few things happening this week. We have the tariffs tomorrow. All right. We already had CPI today, which is great, right? So if I bring up the CPI chart over here, I mean, it was kind of telling you the whole time that CPI was going to be just fine, right? So if I pull up US inflation rate, like we literally came in today at 2.7%, and that's what I was expected to be, right? So does this look like it's going to surprise you to the up or downside? I don't know. I generally don't like to bet in these things, but it's like if I look at this chart, it's like, well, it's not going to be down at 2% tomorrow, and it's not going to be at 4% tomorrow. So it's just going to keep on doing this chopping noise, right? We're basically at where inflation is going to be, right? If we have the Fed being the buyer of last resort for Treasury bonds at $20 billion a month, and then we have Donald Trump supposedly buying $200 billion of mortgage-backed securities to work with the oil, you know, we're going to continue expanding monetary policy. You're going to continue printing. Inflation is going to stay here. As long as it stays tame, I'm cool with that, right? So I don't think inflation is going to be a market mover as much as people thought it was going to be, unless like we surprise in the up or down direction, which we arguably did with core PCE the other time. And the market only went up from there. So like, I don't think the market really cares about inflation anymore. So like, what does the market care about? What does it care about? I think tariffs, we're going to get that tariff decision tomorrow. I think that might be what the market cares about. Let me actually play this other clip, because I think also another thing that the market might care about, but doesn't really think it's going to happen, is this 10% cap on APR rates for credit cards. All right. If we look at some charts here, let's look at how some credit card stocks have been reacting lately to it. All right. So we had Capital One Financial, which is a very big credit issuance agency, or not agency, company. All right. So they acquired Discovery. I forget when they acquired Discovery, but it was sometime last year. So they already had the credit cards that they gave out, and they already did loan out this money. If we do put that cap in, then that means that they're probably going to compress their margins more, because they won't be able to make that much more money off the spread, especially when you go from like 22% APR rates down to 10%, right? So the market definitely thinks that this is going to be an issue, but I don't think the whole market thinks it's going to be an issue. I think only shareholders of these stocks. And see this big red candle here? Like before the announcement even came, it was down like 2.5%. It's like someone knew what was going to happen. But if I look down here, it was down as much as 10%. Now for Capital One Financial, that's actually a pretty decent move. Where did my screen go? Here we go. So that's actually a pretty decent move for Capital One Financial. We did have JP Morgan report earnings today. How did they react to it? Okay, it's down like 4%. All right. So what was the commentary on JP Morgan today? I believe the commentary was really revolving a lot about the credit cards. All right. So CNBC, JP Morgan. All right. Here we go. Let me play this video and see what they got to say about it. It's done. All right. So JP Morgan's down about 4% today, and they very likely Jamie Dimon, the CEO of JP Morgan, said some interesting stuff on that earnings call. I mean, this company usually doesn't drop like 4% like that. I don't want to say it's a super low beta, but it isn't really expected for this company to drop that low on a single day, unless something was like said horrendously on that earnings report. I'm just waiting for this ad to end, and I'm going to play CNBC's clip on like what happened with JP Morgan this morning and some summaries. Hold on. All right, here we go. So let me share this screen.
Picker has those results, and she joins us right now. Hi, Leslie.
Hey, Becky. Yeah, going through these results right now, I see for EPS, the company reporting $5.23 per share. That is excluding the impact from the Apple Card, which impacted EPS by about 60 cents per share. You can see shares up about 1% on these results. Top line was a beat, coming in at $46.767 billion. Analysts were expecting $46.2 billion. for EPS. Net income, $13.025 billion. That was down about 7%. Investment banking fees down about 5% year over year and 11% quarter over quarter. Looking at net charge-offs again, that was impacted by that Apple Card forward purchase, which resulted in about a $2.1 billion reserve build here. Book value per share in the quarter coming in at $126.99 per share. In the release, we have some commentary from Chairman and CEO Jamie Dimon, who said the U.S. economy has remained resilient. While labor markets have softened, conditions do not appear to be worsening. So, some kind of optimistic commentary there. Meanwhile, consumers continue to spend and businesses generally remain healthy. These conditions could persist for some time, particularly with ongoing fiscal stimulus, the benefits of deregulation, and the Fed's recent monetary policy. However, as usual, we remain vigilant, he says, and the markets seem to underappreciate the potential hazards, including from complex geopolitical conditions, the risk of sticky inflation, and elevated asset prices. So shares up about 2% on these fourth quarter results right now, continuing to dig through the release, and we'll let you know what we find, guys.
All right, so it does not appear that when the earnings were released, the commentary didn't come out, but I did pull up this article here that might give a better explanation as to what actually happened on this earnings that the market was actually pretty concerned about. Let me go ahead and share this screen here. All right, so JP Morgan dipped 3% after the company's fourth quarter results beat on top and bottom lines, while company-wide and equities trading revenue increased in the quarter. Investment banking fees fell and missed expectations. Okay, well then this is definitely going to be something right there. So the company makes a lot of money off fees, especially their IB sector or investment banking. That's where a large amount of money is there, so they need those fees to kick in there. But the fact that it missed expectations is something the shareholders probably not happy about. But I also think the company's CFO, Jeremy Barnum, also signaled that the banking industry could push back against Trump's call for a 1-year 10% cap on credit card interest rates, which he declared late Friday. Goldman Sachs followed JP Morgan lower. Okay, so pretty clear here that the banks don't like Trump's decision to have a 1-year 10% cap on credit cards. This is obviously going to affect JP Morgan. If I look at the charts over here, SOFI down again today. SOFI is actually up 2% today, which is pretty interesting to see. So we're getting a little bit of reprieve from this. I think the biggest question is, do markets actually believe this is going to happen? This is supposed to be happening on January 20th. So we have 7 days from now. We have Tuesday, 7 days from now. It's actually pretty interesting. I have a Tesla car appointment on Tuesday. So I will be without a Tesla on Tuesday, most likely. Hopefully, I always pay my credit card balances full, like everyone should be doing every so month. So this 10% cap won't even affect me. But let's see if we have a red day or green day that day today, because it would certainly suck to have the stocks down and also without a Tesla or without my car that day. That would really suck. But hey, Robinhood is green today. We have a bunch of crypto that's green today. So there is another stream. There is another video that I did want to share that there was a bit more discussion on this 10% cap, also from CNBC. Oh, wow, that's cool. Okay, hold on. This is the one I want to share. All right, here we go.
So will a proposal like this turn into policy, and how will this play out for consumers and the stocks? I would think that you see the direction.
I'm not going to play the whole thing. I'm going to play part of it.
And companies might be inclined to say, you know what, we're going to concede something in order to move towards that direction without having to get to 10%.
Fair. And I think there's some middle ground. I mean, 10% is probably a little draconian, but yeah, there is a middle ground. But let's try to play it through the lens of the stock market. You know, Capital One sold off today. It makes sense. It's not a valuation concern here, but I think 60 to 65% of their business is tied to exactly that. Where is this thing going to settle? Well, first of all, the unintended consequences, I believe, will be, okay, we'll ratchet back the rate, but then credit lending probably gets ratcheted down to commensurate with that. So I don't think it's going to do what it's intended to do. But I also think this is going to be somewhat short-lived. I think you buy the sell-off in these names just on valuation. The fact that I understand that earnings are backward-looking, but they report on the 22nd, which is fast approaching, and the quarter's going to be pretty good, I think.
Yeah.
Yeah, I agree with you that it seems somewhat overdone. It's a little bit like mini Liberation Day for these names, but I think that the unintended consequences are great. When you think about, all right, if we got a cap at 10 and we know we've had this sort of credit loss, where does that credit loss come from?
Right.
That person's not going to be able to borrow anymore. The people who do pay back will be able to. That's not how these companies make their money. The revolving balances will go down. That's really where the sort of juice of the business is. I get the intent. I don't know how it would actually come to pass without significant legislative involvement. So I do think it's sort of overdone. I don't know what they need to give up yet at the moment. I think let it play out. Clearly, it's a message that could resonate with voters. Whether you can implement that and how quickly, that's something else.
All right. So we don't need to listen to any more opinions there. We kind of get the gist of it. Banks don't like it. These analysts don't like it, likely because they're long financials. Financials has been performing pretty well for the last few months. In fact, we've seen a lot of rotation out of tech and into financials lately. So clearly they don't like it, right? So who does like this? Who likes the fact that we're going to have a 10% cap on rates? You're not going to see anyone in CNBC say they like it. You know who likes it? The people who are voting like it. And you know what's coming up? The midterms. And you know who needs the midterm votes? The Republicans. And you know what the people who are going to do those votes like to hear? Lower interest rates. I would really think this is the only reason why he's saying it, right? Because like, if the people who own these stocks don't like it, the people who are running some powerful companies in the world don't like it, and Trump says he's going to do it, the question is he actually going to do it? I don't know. He says 10% now. What if 10% ends up becoming like 15% or 16, 70%, 6, 7? What if it ends up being around there, right? I know I was like doing this and I was thinking 6, 7 for some weird reason. Funny thing, I was actually just at the supermarket and someone asked the lady next to me, where can I find this? And she's like, oh, aisle 6 or 7. And like the two people were like pretty old that asked. So like they had no idea. But then she like looked at me and like was like this to me. And I was like, oh yeah, there we go. Anyways, I don't think this is going to go through, or at least I don't think 10% is going to go through. And I think if it does, it's going to be a pretty big shock to the system. Not because it's going to stick around for a while, but because this is going to cause a little bit of uncertainty as far as like what Trump says out of his mouth. Because like let's be honest, guys, half the things he says doesn't actually happen. But if he actually follows through with this, people might start taking the bombs he drops on some of his interviews a lot more seriously than what would happen, which would likely cause more volatility in a lot of people's portfolios, right? So he's already talked about the data center stuff, that a lot of these mega cap companies have to pay for the power for their data centers, right? And if that happens, then they're not going to spend so much money anymore, right? It's just like, there's a certain degree of certainty that comes whenever Trump says certain things like this that are like sporadic and out of the blue that the market takes for granted, right? Because half the time he doesn't really come through with it. But take something like this where it's like 10% cap and like clearly the GSIBs of the entire world or the global systemic impacting banks of the world, the JPMs, Bank of Americas, and so on, they don't like it, right? And the shareholders who own them don't like it either because they're selling off the stock. What if Trump actually does do this? I don't think these stocks are going to trade any higher than where it's today. I think they're going to trade lower. And I think that's going to be a problem. And if it's a problem for them, it's going to be a problem for the stock market. I don't think this is bullish at all. I don't think Trump should do it because I want the market to go up. I mean, obviously, we don't want people paying higher interest on whatever it is, but like we're here for the stock market and like, why would anyone want the stock market to go down? But I do think that this happens, the stock market will likely suffer a little bit. So we got one more week until that one. It can literally just be undone with just one tweet or one truth, right? You have truthsocial.com. Trump posts a lot and then he posts his opinions on there, which are truths on truthsocial.com, a social media platform to find the truth of opinions. I don't know. Anyways, we will see what happens with that one. We have 118 people here on the Google YouTube platform. 20 of you people are on the Wolf Financial, and 98 of you are on my channel. 98 of you guys, head over to the Wolf Financial channel. That's where you're going to be seeing the rest of the stream. Until then, I'm going to have to cut off the stream off my channel because I really want everyone to be on there. That's basically where I'm streaming everything. So if you're on my channel on YouTube, head over to the Wolf Financial YouTube. You have the comment down there below, which is how you can access it. And we're going to continue with the rest of the segment. We're going to go on for about 15 more minutes, and then that'll be it for the stream. So pretty short one today, but definitely a lot more to talk about tomorrow. So if you're on my channel, head over to Wolf Financial or at Wolf_Financial on the YouTube website. People on Twitter, show some love on YouTube. All right, guys, we are continuing with the segment. Hold on. I had to sneeze a little bit. All right, so there's other things that are happening. There's other things that are happening in the market today. All right, let me go ahead and share this screen over here real quick. We're getting some interesting moves with some stocks. All right. I didn't think Intel would be near 50 bucks. I knew it was going to go up. Not I knew it was going to go up. Nothing's ever guaranteed, but I thought it was going to go up after Trump took about a 5% stake in Intel, and it certainly did. But I didn't think it was going to go near 50 bucks that quickly. So there seems to be a bit of a motive to get this to keep going higher. And it's probably because they have ties with the government, and really anything that has ties with the government just pretty much drifts all the way up. You have Kratos still making its way upwards. You have other companies like Rocket Lab that are tied with it. Rocket Lab is down 2% today. It was actually just up earlier today. Of course, you have SpaceX, you have NVIDIA with ties to the government. You know, I mean, this is already like a $4 trillion, $5 trillion company. Actually, it's close to $5 trillion, right? $4.5 trillion company. So this isn't going anywhere. You have Palantir with a bunch of ties to the government as well. Even though software is taking a massive hit today, Palantir still finds itself only down about 34 basis points. But when you look at all the software stocks out there today, DigitalOcean's getting hit down about 2%. Salesforce is making a massive move downward, down to about 7%. Atlassian is down 5%. ServiceTitan is down 5%. Workday is down 5%. Snowflake's down 5%. MongoDB is only down 1%. That's crazy. Yeah, Confluent is getting acquired by, I think it was IBM or Cisco. Who's acquiring IBM? Confluent. IBM is acquiring Confluent, so that's not really going to move anywhere. I don't even have to keep this on my chart anymore now that I think about it. Well, yeah, software is clearly not getting any love today, except for GitLab and IoT and Cloudflare. And then Palantir, it's finding itself nearly flat today, right? I mean, definitely a favorite amongst the retail community, and I would even argue the Wall Street community and government ties. So like, it's very difficult to argue the downward movement on this unless the market goes down in its own. Someone asked me about what's good entry price for Zeta. Let's actually take a look at Zeta here. Let's do this together. I mean, pretty easy to tell here. I usually just bring up the daily SMAs, daily EMAs, and looks like we bounced on the 9 EMA here. So that's providing a little bit of support. The 21 EMA is down here at $21, and then you have the 50 EMA here around $20. Simple moving averages, you really have it's above everything. So the chart looks pretty bullish constructively. If I zoom out a little bit and just look at the moving averages on a weekly chart here, yeah, it's still looking pretty bullish. I mean, if I were to start a new position in Zeta, I don't think it really matter, but I wouldn't go all in right now. I would probably start DCAing and maybe DCA a little bit heavier if the price comes down to around 20 bucks. And then around 20 bucks, you have the 20-day moving average. You also have the 100-day moving average over here and the 50-day moving average down here. Chart's pretty bullish. The 50-day moving average might be coming up the 100-day moving average, which would be extra bullish. If I look at the EMAs on the weekly basis, yeah, about $20 where everything stands. So if this came back down to like 20 bucks, that'll probably serve as good support around here. And then I'd probably average in a little bit more. But again, you always want to make sure that you know everything you need to know about a company before you go in size, right? I kind of like to have like a starter position, maybe like a 2 or 3% position. Now my starter position is 2 or 3% because I've cut out a lot of positions in my portfolio. And holy cow, there's 54 people on the Wolf Financial YouTube channel. Let's go. We have 90. How are 96 people still on my channel? Crazy. I thought I stopped it there. Or maybe they're still watching the older stream. Anyways, let's go, guys. 54 people. Let's go. Let's go is becoming a big thing. I started saying let's go like a year or two ago. So as far as I'm concerned, y'all cut. No, I'm not going to take credit for that one, but let's go. All right. So I think you're going to find some pretty considerable support here around the $20 range. So I would probably go in a little bit heavier my DCA if I were to get in around the $20 range. My position is already built out. And, you know, $17, $18 is not really like a big deal between like $20, you know, but this is like one of those things where it's like, it's not really moving right now because the market's not really, oh, wow, market kind of took a little bit of heat lately. Interesting. Wow, definitely not turning out to be a good day for the Qs right now, trading at the low of days. But yeah, I mean, there's no reason to be like in a rush with a lot of this stuff. You know, I don't think it's gonna like go to like $100 anytime soon. But I mean, I could be wrong. But whenever I build positions, I don't like do it all in one day. I take my time with it. You know, maybe I take like, depends on how much cash I have, depends on how much I'm rotating. But in this case, I think it took me like about a month and a half to build my position in Zeta. So, you know, there is no rush. And if the stock does what I think it does, which means it's going to be at like 75 bucks in a couple of years, then does it really matter whether you get in like $20? I don't know. But when you're playing the options, it really does matter. Yeah, around 20 is reasonable. Thanks, Sam. Thing is conviction into the market economy. But yeah, no, that's 100% true. This is something that I always tell people. First, you got to know your risk when you're buying companies, right? Stocks are one of the riskiest assets out there, right? We're not including crypto in this, but stocks are very risky, right? Nothing's ever guaranteed with this. So make sure you do your due diligence, make sure you do your research and know like what the market or how the market acts in certain economic conditions. And marketing companies do very bad during pullbacks or economic recessions and fears, whatever it is. So, you know, mind you, this is also a high beta stock. So this is probably going to get hit pretty hard, but, you know, arguably from a valuation perspective, the company actually trades pretty cheap in terms of where they're guiding for their revenue to be. So we're looking about 35% next quarter. Free cash flow margins around 10 to 15%. I would even argue that it trades pretty cheap on a forward price to sales basis. So I think it's like about a 4 times price to sales, which, okay, that's not exactly like the cheapest stock out there. But when you think about 35% free cash flow, 35% revenue growth, additional profitability around the corner, free cash flow positive, you know, the argument kind of seems pretty good there, especially when it's accelerating revenue. Again, like the secular theme of accelerating revenue is also very important to stay in companies that are cheap, right? So you have a company that's not accelerating revenue, then that starts to become a bit of a question as to how much premium we need to give this valuation, right? Take On Semiconductor, they actually are shrinking, right? They shrunk like 7-8% last quarter, and they're probably going to shrink again next quarter. But I think we're pretty much are at the bottom of where their revenue deceleration is going to be, and from here, revenue will accelerate, right? So they're targeting about 10 to 12% revenue growth in the next couple of years. So that means you're talking about an acceleration, right? Amcor, okay, a lot of people say like their gross margins are not that great for this company, but like they're going to be expanding their gross margins. They're going to be accelerating the revenue as we bring more chips and manufacturing onshoring to the US, specifically in Arizona, where TSM is going to build another 5 factories according to the tariff negotiations with Taiwan. That's more revenue for Amcor, which is also located in Arizona. Coincidence? I don't know. Maybe not a coincidence. Maybe they planned it. I don't know. Who knows? They're going to be accelerating revenue, right? So we're not talking about triple digit crazy revenue for high beta growth stocks. We're talking about like acceleration revenue, but a slow acceleration revenue where it's going to be sustainable for a period of time, which will slowly drag that price up. I'm actually in the weekly chart over here, so I'll put it on the daily chart so that way it's not like skewed or anything. But yeah, you know, and a lot of the stocks that I own are accelerating revenue. This is actually really interesting seeing this big down moving path. You know, there's a bit of it's got a bit of a gap over here, but there's also argument both sides, and the reason why path may be like a bit misunderstood from like both perspectives. Like, you know, you have your bear saying like this company's moat is like gone, and you have the bull saying that this is going to grow revenue to like 10, 20, 30%, you know. So if that actually does happen, you can definitely expect this company to be re-rated upwards. So this might take a little bit more patience to be in. But yeah, I mean, it's the concentration portfolio, other than seeing Amazon down on the day, other than Meta seeing down, the concentration really lies like in, let me actually bring this up here. I'm going to bring up my Savvy Trader real quick, and you guys will be able to see. So my Savvy Trader, hold on. I should actually put up a spreadsheet and update my spreadsheet in terms of my portfolio. This is the problem with Savvy Trader, is that you can't do options in here. So you can't really get a holistic view at what my portfolio is looking at. And plus I also separated my portfolio on Savvy Trader. By the way, if you really want to follow like when I'm trading, when I'm doing like that, like to be honest, I'm not active on Savvy Trader, so you don't have to go on Savvy Trader and subscribe to my portfolio. You could always just ask, and I generally post like my portfolio holdings from time to time here and there. So I'm not trying to like market this or anything, because like you certainly don't have to do it. You could always just ask me, or you could just like wait for me to post it. But I am planning on putting my portfolio together and posting it on Twitter and stuff. So this is more just like, this is like a great way to keep myself accountable for what I actually do own, right? So I have a large concentration in Amazon. It's actually more than 16%. It's closer to 20%. Amcor is a decent sized portfolio. I have options with Amcor. Mercado Libre is a big part of my portfolio. And you have Zeta here, Rubrik, On7 Vector, Path, Grab. Man, am I becoming a... Now, you know what? See, this is the thing. It's like there's certain companies where it's like I've been in Grab for almost 2 years now, right? I'm not going to sell Grab. Like I can't sell Grab. I really love the management of this company, and I don't mind just holding on to this for a period of time. But we think about Adobe here. This actually is not 5% portfolio. It's a lot smaller than that one. This was much newer in the portfolio. So it's like, I haven't really built that like tight conviction with it. Been holding ENS for some time, Robinhood for some time, Meta for some time. In my other portfolio, I also have Nebius, which I've held for some time, and Lemonade, which has done pretty well. My average in Lemonade is like around the $28 range. It's not correct here on Savvy Trader, but it's been here for a while. And Iron, of course, a lot of you guys already know about, which is actually up about 4% today. They got a double upgrade from what's the name of that sell side firm, HC Wainwright. So HC Wainwright actually had it listed as a, I believe it was just a buy rating, or was it a hold rate? Oh, it was a hold rating, and they upgraded it. No, it was a sell rating. They upgraded it to a buy, which is just a double upgrade because it goes from sell to hold to buy. And some sell side firms have like underperform, this underperform, and then they have sell, and then they have like hold, and they have buy and outperform. Like I don't know like where they get these 5-tier ones. Maybe that's just 3-tier. I don't know. But HC Wainwright did go from, actually I did post about it this morning. Let me bring it up real quick. Yeah, so HC Wainwright went from a sell to a buy, and then they increased the price target from $56 to $80. So IREN has been seeing a bit of a tick up, and it's not just lately. It's actually been happening for some time, where like pretty much all these NeoCloud and BTC miners did drop from it. Yeah, strong buy. I don't like. Is it a buy or not? Like, you're pounding the table when it's a buy, but you're like really pounding the table when it's a strong buy. Like, I don't understand that, right? It's either a sell, buy, or hold. That's it. Anyways, I read a lot of these companies actually bottomed out like back here in the middle of December. Iron was all the way down to $33. So since then, we're actually up pretty considerably from this low. So we're up about 53% since that low. So that's been some pretty interesting price action. But if you look at all the other ones, like those kind of bottomed out as well, right? So it's not just Iran. It's also Nebius. Nebius is up about, it was as low as $75. So we're looking at about 38% hike since then. Cypher is balanced pretty considerably. In fact, Cypher actually did bottom back in November, which is interesting to see. Height has been an insane run lately. This one is basically doubled. Applied Digital has been on a crazy run too. Almost doubled there. But yeah, it looks like this entire sector kind of did bottom about a month ago. So they'll post about the Anthropic deal, whatever, like negligible, right? Like to me, it just seemed like someone was trying to pump the stock. I'm more about like the long-term price action versus like one-day pumps, and 4% up, pretty sustainable. Hive is up a lot. I don't know why Hive is up a lot. But I mean, it's mixed performance around the board. Applied Digital down 4%, but it's not been a crazy run. Same with Nebius, so like they're generally doing pretty good. Like when I look at this, like I don't see risk off. I just see like basically chop markets waiting for some stuff to happen, right? I mean, if you own the Dow, then you're probably not doing too well, but you literally just had all-time highs yesterday. So, oh well. IWM's outperforming. So, a little bit of some weight action over there when it comes to the stock market. But I think that does it pretty good for today. Oh yeah, I forgot to talk about AMD. Why was AMD even up a lot today? It's up about 7%. That's a crazy bounce for the 200 level. All right, guys. So that does it. About it. A little bit of a short one today. We're on for about 46 minutes. But we're definitely going to get some clarity tomorrow when it comes to that tariff decision from the Department of Justice. I'm actually pretty interested to see more of how the market reacts to it than anything. And I don't know if we're getting it in the morning or in the afternoon. I hope we get it in the morning so that way we can just like get it over with. But they're probably going to do it like after close where volume is lower, which is going to be very annoying. But anyways, guys, thanks for tuning in. Again, if you're on Twitter, tune into the Wolf_Financial YouTube channel. There's lots of stuff on there. I actually just did a podcast this morning with Grayscale head of research, Nick Pandel, and that was actually a pretty good one. Dove very deeply into the crypto space, which I'm not too knowledgeable on, but I try to follow as much as I can, and he's very knowledgeable in that one. So that's going to be in the show notes available in case you want to check that one out. Appreciate you guys being here. No problem.